America's $31 trillion debt bubble is on the verge of collapse because you can see that the debt has been skyrocketing out of control over the last 20 or so years, going from $9 trillion in 2008 all the way up to $31 trillion today, a 300% increase over just 15 years. And it's gotten so bad that now our total debt is bigger than the size of our economy, with America's debt to GDP ratio clocking in at 119% in 2023. That's double the long-term average of 60%. A situation that many people in America ignored over the last several years, but now they're definitely paying attention because it is now bumping up against the debt ceiling, a statutory limit on how much money that America can spend, with the debt ceiling last being raised in late 2021 to $31.4 trillion. And so we were basically able to take out more debt over the last year up to this $31.4 trillion, but now we're smacking against the debt ceiling, which means that we need to either raise it or the government's going to run out of money. And if the government runs out of money, some crazy things are going to go down. We could potentially default on our debt, like I talked about before, which could cause bond yields and interest rates to surge and plunge our economy into recession. Alternatively, the government might just stop paying its employees and having to furlough them and lay them off, which would cause the unemployment rate to skyrocket and consumer spending to collapse, with big corresponding declines in the housing market and stock market. And more people, specifically bond buyers, are starting to bet this might happen, with the yield on the 1-month US Treasury bill surging over the last month or so. Check this out, everyone. Back a month ago, the 1-year US Treasury yield was 4.3%. Now it's 5.7%. The reason the yield is going up is because more and more bond buyers are demanding a higher return for the increased risk that we don't increase the debt ceiling and default. Now, that's not a guarantee that we're going to default. In fact, I think it's likely that some type of deal is reached over the next couple weeks before we hit X date where the US government runs out of money. However, even if a deal is reached, my fear is that the core problems with this debt are going to continue to get worse into the future in America, and that we're going to have this song and dance about the debt ceiling every 1 to 2 years. And the core problem is simple, everyone, is that the orange line, spending by the US government, keeps surging, now up to $6.5 trillion a year in spending by the government, while our tax receipts, the blue line, are not keeping up. And in fact, the tax receipts are going down right now, which is another recessionary indicator. But really, it's the widening gap that started around 2007, where the spending is going up further than the tax receipts, that's creating this situation where we keep running these deficits and the debt keeps growing. That's why the Republican Congress and many Americans want to see spending cuts. I think most of you watching this video know that these types of increases in debt are not sustainable. And at some point that we're going to have problems from taking out this debt. Maybe inflation gets worse in the future. Maybe our interest rates and borrowing costs go up in the future because we keep becoming so indebted. But something needs to be done, which is why, according to a new CNN poll, 60% of Americans say the debt ceiling should increase only if we cut spending. That compares to 24% of people who said Congress should raise the debt ceiling no matter what, and 15% of people who said that we should just default. So 75% of Americans are on board with saying we need to do something about the spending. However, the problem is that the spending is not going to be so easy to fix, because when you dig down deep into the data on where the US government spends its money, you see some very concerning trends. This graph tracks how the composition of US government spending has changed over the last 70 years. What I want you to pay attention to is this blue line, discretionary spending. Back in the 50s and 60s, discretionary spending, which is the military, its infrastructure projects, its government offices and programs, was 60% of the budget. Since then, that has now declined to 20% of the budget, meaning that we don't actually have as much room as we think to cut discretionary spending. At the same time, this yellow line, social transfers, which is primarily Medicare and Social Security, has gone from being 16% of the budget to now nearly 50% of the budget. Additionally, interest cost on the debt, the orange line, is now 14% of the budget and will likely keep increasing into the future due to the Fed interest rate hikes. So this is the problem, everyone. Nearly 2/3 of US government spending goes to Social Security, Medicare, and interest costs, items which are mandatory and cannot easily be cut. And the reason that's happening is because the US population is aging. More people are now taking out of Social Security and Medicare than putting in. At the same time, because our debt's been so high for the last 2 to 3 decades, our interest costs are now going up, which means that the cuts are likely going to have to come from the 1.3 trillion discretionary budget and the 1 trillion state and local aid budget. This is where we're going to have to cut spending as a country going forward, really no matter what. Even if we don't do it in this round of debt ceiling talks, these items are going to go down into the future as the social transfers through Medicare and Social Security go up and the interest cost goes up, which essentially means that the party is over, everyone, in the US economy and with US government spending. We had a good 20 to 30 year run where interest rates were really low and the economy grew and the government was just able to borrow and borrow and borrow and our demographics were still okay, and that fueled our economic growth. But that is no longer going to happen into the future, and that's going to mean less economic growth into the future. That's going to mean more risk of recessions into the future. That's going to mean bigger problems for the housing market into the future. And I think the biggest thing that bothers me about the debt ceiling discussion in the media is that I don't see the media addressing these core issues. I see the media kind of talking about it in a Republican versus Democrat type of way. But honestly, we had presidents and leadership from both parties over the last 20 to 25 years that got us in this position with having so much debt and now being in a situation where we cannot afford to pay it. And the scary thing for our economy is that it's not just the US government that went on a debt binge over the last 3 decades. It's also big businesses and corporations. With data from the Federal Reserve showing that total business and corporate debt in America is now up to $20 trillion. That's basically double its level in 2008 at the peak of the previous bubble before the last big crash. And so this corporate and business debt, which was borrowed at cheap interest rates, is also something that fueled the economy, fueled employment, fueled economic growth. But now the chickens are coming home to roost here as well. Because due to the Federal Reserve's massive interest rate hikes over the last year, short-term yields are now over 5%. The cost of borrowing for businesses and corporations has gone way up, just as these businesses are being forced to refinance and roll over their record high $20 trillion in debt, which is now causing a wave of bankruptcies. With CNN Business reporting that corporate bankruptcies are on the rise and that the pain won't end for a while. With corporate America last week having its worst 48-hour stretch of bankruptcy since at least 2008, according to data from Bloomberg. So far, more than 230 companies have filed for bankruptcy in 2023. Fundamentally bad news. It says that we're going to continue to see problems and that the growth is going to get worse, more companies are going to go under, and more people are going to get laid off. That's what this data said. Now, interestingly, at the same time, the stock market's completely ignoring it. The stock market has rallied over the last month to 2 months. Specifically, the NASDAQ is going up because everyone is going nuts over AI, thinking that this AI revolution we're in right now is going to lead to just huge productivity gains. A company like NVIDIA just had a big earnings report and their stock is up like 40% in a day. And so there's still this crazy mania in asset markets that I look at and say, what are these people thinking? Because when you look at the US debt, when you look at the corporate debt, you look at interest rates, you look at the trends in home sales and mortgage applications, I mean, all of this makes the economy look really bad from a fundamental perspective. And unfortunately, I think a lot of the people who are buying into this run-up in this bubble are going to get hit really hard over the next year or 2 years as it unwinds. Because when I look at the housing market, for instance, everyone, I'm looking at a market that is dead right now. It's collapsed. It's frozen. Mortgage applications to buy a house, they just went down again to an index level of 158. That's down 30% year over year. That's down 35% from the pre-pandemic norm. And that's down more than 50% from the peak in 2021. And so folks, I want you to understand what this graph is saying. Home buyer demand is literally at close to the lowest levels on record right now. And that's with mortgage rates from 6.5% to 7%. If we have issues with the debt ceiling and mortgage rates go up further, this is going to collapse further. And such low home buyer activity in the housing market indicates that other parts of the economy are going to struggle as well. Last week, we talked about Home Depot's bad earnings report. This week, it was Williams and Sonoma and West Elm that reported an insane 40% decline in net earnings year over year. Less people are buying expensive furniture and home goods because less people are buying houses. That's going to lead to layoffs in the retail and manufacturing sector. And so the fundamentals simply do not look good for the US economy and housing right now. And I don't say that to be bleak. I just say that because I'm looking at the data and feel like this needs to be reported to you guys so you can see the truth about what's going on. Now, lastly, everyone, I need to make one more comment about the debt ceiling, because I see a lot of people reporting some misinformation in the mainstream media about what would actually happen if the debt ceiling wasn't raised. And a lot of people say, well, the US is going to default on its debt. But in actuality, that won't happen. Even if the debt ceiling doesn't get raised and the US government runs out of money, it's unlikely we default on the debt. Because remember, of our $6.4 trillion in total spending, $900 billion is in interest. So we have actually more than enough money in our $4.8 trillion in tax receipts to pay this interest. So we will very likely prioritize paying the interest as well as the social transfers for Medicare and Social Security first, while discretionary spending and state and local aid will get cut. So that makes furloughs, pay freezes, and layoffs across the US government the most likely outcome of a failure to increase the debt ceiling, which of course would have a big negative impact on the economy, but I don't think we're gonna see the negative impact be from us specifically defaulting on the debt, because I think we're gonna prioritize paying those interest payments no matter what.